Good evening, everyone, and welcome to our third quarter webinar on the move, hosted by my co-host, Adrian Day. For those of you who are not familiar with Adrian Day, I'm not sure where you've been. He's everywhere. He's written like 3 different books. He's on every TV and radio show you can think of over time, and rightly so. He's an honor graduate of the London School of Economics. He came to the US and started out as an investment writer, investment newsletter writer, and he has turned that into a very solid asset management practice. He also manages the Euro-Pacific Gold Fund. He's recognized as an expert in international and resource investing, and I'm glad to be associated with Adrian Day. And Adrian, I'll hand it over to you to introduce our special guest this evening.
Well, thank you very much, Rich, and that was a long introduction. And for those who don't know Rich, gosh, I've known Rich for, is it 40 years now? He's
Something like that.
President and COO of Asset Strategies International, a firm that specializes in gold investments, bullion, the Perth Mint, and other gold investments. And I'm sure we'll get into that. Well, our special guest this evening is someone else that I've known a long time. I don't know how long you've known him, Rich, but Alex Green, I first met when he was a broker, or do we call you investment advisors? When he was a broker at a small regional investment company back in what, 1990, I'm guessing? So
no, it was 1985, Adrian.
Really? Well, it seems as though we're younger than we are. So for those who don't know Alex, he's got a storied career. He's doing many things, but I'll just name a couple. He's the Chief Investment Officer of the Oxford Club. Many of you will know that. And he's also written, 3 best-selling books, including the legendary Gone Fishing portfolio book, which was a New York Times bestseller. So why don't I kick off, if I may, Alex, and ask you about the Gone Fishing portfolio. What was the genesis of that idea? Can you describe it? And then also tell us, what the results have been, how it's performed.
Okay. Yeah, I'd be happy to do that. Yeah, I wrote the book in 2008, and I was surprised that it was an immediate New York Times bestseller. But the portfolio itself goes back now over 20 years. And I created it because I was trying to show people a very simple way to handle what I would call like the foundation stone of their portfolio. And I say this in part because, as you know, I was in the money management business for a long time, and I found that a lot of smart, well-educated people were handling their portfolios like chips. They were chips in a poker game, and they buy some of this and sell some of that, and they read an article that this, and their golf pro would tell them about that, and I'd look at their portfolios. They couldn't remember what they bought and why they bought. It was just such a mess. It was just totally. It was totally undisciplined. And so I told people that if they got the foundation stone right, then they could go out and explore and do other things. This is really the most conservative portfolio that the Oxford Club has created. And essentially what it is 10 Vanguard index funds, or ETFs, that represent 10 different asset classes. And of course, just to make sure everybody understands that an asset class is a different group. The big asset classes are stocks and bonds, but then you have growth stocks and value stocks and foreign stocks and domestic stocks and large caps and small caps. And then the bond sector, you have high yield and high grade bonds and inflation adjusted treasuries. And of course, you have gold and gold shares and real estate investment trusts and so on. So these 10 different asset classes are in there, and there's various percentages for each asset class. And the idea is you just put the money in there, and then once a year you rebalance to bring all those percentages back to their original value. And that's all you do. The rest of the time you go fishing. That's why it's got the name of the Gone Fishing portfolio.
You have to fish?
What's that?
You have to fish, or can you do other things?
You can play golf, you can travel, you can do whatever. You don't have to fish, but the idea is you can set up your portfolio, rebalance it once a year. It takes 20 minutes, and you can do perfectly well. It's actually a very sophisticated money management technique. You're very well diversified. You have ultra low costs. It's highly tax efficient. You're totally asset allocated and diversified. And again, it's very conservative, and yet it's beaten the S&P 500 slightly over 20 years. But and incidentally, this can all be verified through Vanguard, because these are Vanguard funds. But you accepted a whole lot less risk, because 30% of the portfolio is bonds. So it's a third less volatile than a stock portfolio, and it's done actually slightly better than the S&P 500. And it would have done a whole lot better, except for the fact we've got international markets in there that have now, as Adrian knows, international markets have lagged the US market now for quite some time. I don't think they'll lag indefinitely, or we wouldn't have those different asset classes in there. But eventually, these very cheap markets relative to the US will do quite well, and they'll provide a performance kicker. But that's the gone fishing portfolio in a nutshell.
Well, it's a little bit like, remember Harry Brown's permanent portfolio?
Oh, yeah.
It's a little bit like that. Now, you've expanded that. Why did you expand it from, I think Harry Brown had just the 4 major asset classes: stocks, bonds, cash, and gold.
You're right. Incidentally, I so miss Harry Brown. Harry Brown was a great guy. He, in addition to writing a great investment book, which is Why the Best Laid Investment Plans Usually Go Wrong, he wrote another classic book, which everybody should read, called How I Found Freedom in an Unfree World. And Harry Brown's permanent portfolio, which became a mutual fund at one point, you're right, it had stocks and bonds and Swiss francs and gold and so forth in there. So anyway, the reason I did these different asset classes is that all these asset classes will give you a positive return that beats inflation over time, but you can't know in advance which asset classes are going to perform the best. And so you spread your bets, and then over time, for instance, large caps will outperform small caps, or bonds might outperform stocks, or gold might outperform everything. And all the years that they underperform, you're adding to them when you rebalance. Rebalancing forces you to buy what's low and sell what's high.
Yep.
And then over time, all these assets all go through various cycles that are almost completely unpredictable. And so by spreading your bets and rebalancing the portfolio, you've just done something extremely sensible with the foundation of your portfolio. And then if you want to go out and overweight gold, or buy stocks that the insiders are buying, or speculate on artificial intelligence stocks, or whatever it is else is you want to do, you have your home base covered, in that you've done something very sensible. You've got an asset allocated portfolio, diversified, professionally managed, but without big management fees, ultra low cost, high tax efficiency. And if someone does that, they're already ahead of 97% of the investors out there, because most people are doing something. Most people I know from being in the business are doing something almost witless. Because whenever I would have a prospect come to me when I was in the money management business, the first thing I would say is, well, let me see what you're doing with your portfolio now, because maybe what you're doing is so good that we won't be able to improve on it. That was, believe me, never the case. But they would show me what they were doing. And then when I would ask them why, what was the logic, what was the strategy, what was the philosophy behind it, they would just throw up their hands. And this is the money they've worked their whole lives for. They've earned it, they've paid taxes on it, they've saved it instead of spending it. And now all they have to do is manage it sensibly to beat inflation and live comfortably in retirement. And they're handling it badly because they're good at taking out gallbladders or running a chain of dry cleaners, but they don't really know how the financial markets work, or they tend to be overconfident. They think they know how things work. And they tend up underperforming badly. So again, if you're doing something very sensible as the foundation for everything you're doing, then you can't go too far amiss.
So, yeah, let me, before you jump, sorry, go on, Rich.
No, I was going to say, we're going to get in a second, later in the program, we'll get into overweighting gold, as you mentioned earlier. Some people tend to do. I want to tell a little story about that back in IU. I think you know which one, Alex. But before I do, there's another camp out there that says, listen, diversification is out. It's so last year, last decade, last century, that the thing to do now is not diversify, but to focus on one or two things and make tons of money. There's that other camp out there. Is that realistic for the average investor?
Well, for the average investor, no. For someone who's super sophisticated and spends their lives managing money or looking at the markets, it's possible. You know, most of the great fortunes have been created by concentration, not by diversification. Bill Gates didn't diversify so far beyond Microsoft. Elon Musk didn't diversify so far beyond Tesla. I mean, they have a very concentrated portfolio. And even Warren Buffett has a fairly concentrated portfolio. He owns dozens of companies, but actually the top 5 companies make up a significant portion of the whole portfolio. So it is somewhat concentrated. But you'll notice that at the same time, Warren Buffett's investment advice to the average investor is buy an S&P 500 index fund. So yes, it is, if you're a money manager and you want to beat the market, the chances of you buying 500 companies, but not the ones in the S&P 500, or picking 200 of the companies in the S&P 500 and beating the market are not good. But if you use a very concentrated approach, like for instance, I'm drawing a blank now on the guy who runs Pershing Holdings, Bill Ackman. Bill Ackman uses a very concentrated approach. He usually has almost all this money in about a dozen stocks, and he has beaten the market for a long time using this approach. But for the average person, you have to say, well, what if I buy a dozen stocks and those dozen stocks badly underperform the market? That's always possible. So 12 well-chosen stocks, that's somewhat diversified and still concentrated, but you're taking a bigger risk. The idea about buying the Gone Fishing portfolio is that you have a very minuscule chance of just blowing up your portfolio because you did something that wasn't sensible. So again, as I said from the outset, this is the most conservative portfolio that we offer at the Oxford Club. It's also very popular. I still run to people all the time and they say that portfolio has made me a millionaire. Thank you so much. And I pay 20 minutes attention to it a year, just like you suggested. So that's the idea. It is a very diversified portfolio. There are people out there who say you should take a more concentrated approach, and I don't necessarily disagree. But the question is, if you're running a business and spending time with your wife and your kids or your grandkids and traveling and playing golf, do you really have the time to ferret out 10 or 12 companies that are going to beat the market? Probably not.
You miss one
Well, I
signal.
think that's the key.
Big
Sorry.
deal. Yeah. I was just saying, you miss one signal, it could be a big deal when you're doing other things.
Yeah. No, that's the key. I mean, in the Gone Fishing portfolio, the odds of you losing a meaningful amount of money for a meaningful period of time is minuscule.
Correct.
I can buy 12 stocks or 10 stocks that I really like, and maybe the hypothetical I can beat you, but not without watching those 10 stocks very, very closely. Right. And not without taking a high degree of risk, if something goes wrong unexpectedly. I mean, I think the big problem with a lot of investors, frankly, a lot of retail investors, it's not their full-time job. They're doing other things, whether they're retired, as you say, and playing with the kids, grandkids, or whether they're working. It's not their full-time job. And they want too much from their investments. They want their investments to get them rich. And to me, for most people, the investment should be a way of holding on, preserving your wealth, not of becoming wealthy. I don't know if you agree with that.
Well, I think if someone is young and has a long time horizon and is aggressive in their approach, yeah. But if you're recently retired and now all of a sudden you're going to try to go to the races with your portfolio, that's probably a mistake with the money you've spent a lifetime accumulating.
Well, I'll tell a story, if I may, just like the one you had. Someone at a show said, could I look at his portfolio of gold stocks? I say, sure. Gets out a notebook. Alex, there must have been over 200 names. There must have been over 200. And I said to him naively, are these all the stocks you're considering or you've owned in the past? Oh, no, this is what I own now. So I picked one at random that I've never heard of. Let's call it a Consolidated Ajax. I said, oh, I don't know this one. Is it a gold company? Well, I'm not sure. Well, is it in production or exploration? Not sure, etc. This went on for a few minutes, and I said, well, why do you own this? Oh, well, and then I won't name him because it's not his fault, but I read about it in so-and-so's newsletter. Okay, said I, does he still own it in his newsletter? Oh, I don't know. I stopped subscribing. Well, if you're going to take someone's advice to buy, at least follow their advice to know whether to sell or not.
Yeah,
Anyway.
you're so, but Adrian, you're so right, and I've got a feeling that a lot of people listening are falling into this camp in one way or another. The idea of someone owning hundreds of companies that they've bought, I call it investment by agglomeration. They read about this one in Forbes. They heard about this one from their golf partner. They read somebody's newsletter and bought this one. The idea that you're going to put this mishmash of companies together in a portfolio and it's going to somehow magically beat the S&P 500. I mean, Adrian, you know this, 3 out of 4 professional money managers fail to beat their benchmark every year. Over a period of 10 years, 95% of them do. So if you're a professional who's devoting all of your time every day, every working day, you have this huge staff of people, you've got the latest technology, you've got reams of knowledge and experience, and 1 out of 20 of these people is beating the S&P. What are the chances of this person at home picking and choosing this stock, that stock, I'm going to buy this, sell that? There is no chance. That's why Warren Buffett says to buy an S&P 500 index fund. That is the least dumb thing compared to getting in there and just grubbing around, buying and selling, holding, taking a tax loss here, taking a profit. You never get hurt taking a profit. I mean, I say this in part because I told someone about a stock, and I later on it had doubled, and I said, they told me they bought it, so I said, I guess you're happy with it. Oh, I sold it the next week. I had made $5,000, and so I sold it. And it's crazy. There was no reason for it other than it never hurts to take a profit. So he sold it a week later, and of course for 10% gain or whatever. And a year later it had doubled, but he didn't have any. There was no strategy. There was no investment philosophy behind what he was doing. And everyone should have. Adrian, you have this, and Rich, we have this. We know it's tough. I mean, I've beaten the market in the past. There's no guarantee I will beat the market in the future. It's a tough game. All the smartest people in the world, not all the smartest people, but the people out there you're competing with are some of the smartest people in the world, because the rewards are so great in the financial markets that you better have an edge, not just a perceived edge, a real edge that gives you a chance of beating some of the smartest people in the world who, again, have all this technology, all these people, all this support. Who's on the other side of your trade? You're buying something, who's selling it to you? You're selling something, who's buying it from you? Could be some of the smartest people out there. So it's a challenge. And so you really have to be doing something that gives you a real edge in the markets. And we can talk about what some of those things are, but I think that you have to, again, not just feel like you have an edge, but have a genuine edge to even have a good chance of beating the index.
Well, I think one thing is that an awful lot of people in investing, whether they're retail or even professionals, they feel they have to be doing something. Patience and doing nothing. I always tell my investors, if they say to me, well, you haven't bought or sold anything for 3 months. I said, that's not because I've been fishing. I mean, it's a conscious decision not to do anything. Right. But for me, that is the most difficult thing of all, is not to do anything. And, Warren Buffett famously doesn't have a Bloomberg terminal. We know John Templeton didn't have a Bloomberg terminal. I think all the information that we have makes it much more difficult to be patient, frankly, because you're always wanting to do something.
Right. Charlie Munger said that Warren and I often feel that sitting on our hands is intelligent behavior. And the thing that Buffett says too is, he goes, if you're an individual investor or an individual investment advisor, you can sit there and wait for the perfect pitch. Whereas money managers are so highly scrutinized. They don't want to have a bad month. They certainly don't want to have a bad quarter. And if they have a bad year, they're probably out the door. There is so much pressure on them to buy what's hot, to sell what's not, to constantly be in motion. And the problem with that is you end up chasing, yesterday's winners. You also end up generating a ton of capital gains, which doesn't hurt in a qualified retirement plan, but in your regular accounts. I mean, I think everyone has had situations where they had a fund or a portfolio that was up, and then the April 15th rolled around and they had this whopping tax bill from all these short-term gains, and that can hurt too. So again, it has to be a well thought out strategy in order to have a reasonable chance of beating the market, beating inflation, and beating the tax man.
Right.
Well, Alex, we've got our first question here, and I will caveat this for the listeners that, as Alex said, this is one portfolio. It's conservative, probably the most conservative portfolio they have, but it's one of several. But he's asking, since we talked about the gone fishing portfolio, how well did the portfolio do last year when the S&P 500 and the bond markets were getting rocked?
The portfolio was down last year. There's no guarantee.
Everything was pretty much down last year.
Yeah, it was down. It was down less than the market was, which that's the idea behind the portfolio. It's less volatile. 30% is in bonds, and bonds had a bad year too. But we had some gold shares that held up pretty well. We had some real estate investment trusts that did okay. It was a down year for the gone fishing portfolio, but we did better than the S&P 500. And going back to 2008. We did way better than the S&P. That was one of the worst years for the market. That was the year of the financial crisis.
Yep.
And so that's one of the beautiful things about it is we've had a lot of years when we beat the S&P, but then also a lot of down years for the S&P where we did better.
Gotcha. If I could, I want to kind of hit on this note because last year was a down year, and if there wasn't enough negativity in the world of financial markets and economies, we certainly added to it last year, I would dare say. You can do some damage to your portfolio by not being in the game at all because you're scared and sitting on the sidelines. And one of you asked Adrian how long I've known Alex ever since he came to the Oxford Club, because we've been speaking at their conferences. I think Michael was at their first one ever. There was a chapter meeting in Annapolis, and we've been at every one ever since. And one of the things I look forward to every year is going to Investment U, and I'm one of the guest speakers, the gold guy, right? But I'm usually up front because when they ask, I immediately say, yes, we're coming. So I guess that gets me up early in the program. And in the last 5 years or so, I've followed Alex. And I love that because you're always so darn positive. Now, everybody thinks that I'm a gold guy. So I have to believe that the world is coming to an end, the sky is falling, and I am Chicken Little, and nothing could be further from the truth. We've talked about this oftentimes. And your positivity is very infectious. I think it's needed desperately in this world. And my first question is, where does that positivity come from? Because a lot of what you read in the press and the markets and everything else is very, very negative. The world is right on the verge of death, if you believe most of the things you read and listen to. And you have a very different view. You want to share a little bit of that?
Yeah, I'd be happy to. Well, let me begin by saying that there's a bias in the media, and everybody's familiar with the political bias. You're going to get a conservative bias at Fox News and the Wall Street Journal. You're going to get a liberal bias at the New York Times and MSNBC and CNN and whatever. But there's a pervasive bias that runs across the media, which is a negativity bias. And that is, if it's not negative, it really isn't news. Bad things happen quickly. Good things take time. It takes quite a while to put a building up. It takes only a few moments to knock a building down or to burn down. And part of it's the nature of the news. People don't want to hear about the buildings that didn't burn and the planes that didn't crash and the surfers that weren't bitten by a shark. The news is the extraordinary, terrible things mostly that happen every day. In fact, the news is just a non-random sample of the worst things happening all over the world every day, especially because you've got 8 billion people walking around with a cell phone or smartphone with a video. And so you get to see footage of the worst things happening everywhere. And it's important to realize that there are a lot of positive things happening. And I will talk about some of those positive things, but let me tell you how I first got on this track. When I started back in 1985 in the brokerage business, I would make some money for my clients. I would lose some money for my clients. Some of the things worked out, some of them didn't work out. And I was so frustrated that I feel like I was just spinning my wheels, and my clients were frustrated. They weren't making much money. And so just out of sheer frustration, I started following the best investors in the world. Now, at the time, this is back in the mid 80s, it was Warren Buffett, who was running Berkshire Hathaway as he is now, and Peter Lynch, who was running the Fidelity Magellan Fund, the best mutual fund manager of all time. And as Adrian mentioned, John Templeton, the pioneer of global investing, ran the Templeton Growth Fund. And so I started just making it my mission to study these men and their methods. And I thought, like, how do they know when to get in the market and when to get out and when to buy and when to sell? And what I found out was I wasn't even asking the right question. They all said the same thing. I have no idea what the market's going to do. All I know how to do is to identify a company that's selling less than for what it's worth, and then sell it when the market recognizes that value. And so that was one thing. These were different men with different techniques. I mean, Templeton was a global guy, Lynch was a growth guy, Buffett was a value guy. But the one thing they had in common was an optimism about the future that simply didn't have an off switch. They all believed that they were content to hold stocks long term, because whatever happened in the short term, they were always agnostic about the short term. The market could go up, the market could go down, who can say? But over the long term, and anybody can look at a chart of stocks for the last 200 years in the United States and for the last 100 years or so in international markets, and the trend lines are higher highs and higher lows. That is the long-term trend in the market. You should know your history. The bad things that come along are mostly unpredictable. For instance, I walked into my office in October, on a Monday morning in October of 1987, and the stock market crashed. And the surprising thing about that was, nobody got shot, no government failed, no currency crashed, no, there wasn't some bolt out of the blue, and yet the market gapped down at the opening and didn't stop falling until it lost a quarter of its value, and nobody really understood why, other than the fact that the programs kicked in and computer knocked the market down, which can't happen. Is now they have these safety switches that prevent that from happening. But the market crashed in 87, nobody saw it coming. The market had a bear market in 1990, with Saddam Hussein going into Kuwait, nobody saw it coming. Nobody saw the dot-com rally coming, and then of course it crashed. Then we had 9/11, nobody saw that coming. Then we had the financial crisis, and then we had the pandemic, and then we had the big bear market of last year. And who predicted all these things in advance? Nobody did. But even through all these terrible things that happened, stocks went on to new highs, and we're in a new bull market now. So the thing is, you should be very cautious about what might happen next week or next month, because nobody knows. But you should be confident that over the longer term, stocks are likely to head higher. And if anybody here wants to disagree with me on this, I'm happy to toss it around, because nobody can say with certainty what will happen. But you can certainly see that long-term trend has been higher. And as Patrick Henry famously said, I know no way of judging the future than by the past. And that is what's happened with stocks as they've headed higher. I never did really get around to answering your question about why I'm so optimistic, but I don't want to take all the oxygen out of the room by talking over top of you guys. So feel free to ask away.
Well, just to go a little deeper on that thread, and maybe I'll spark some of those thoughts. You were very kind. You brought Marion Tupy from Cato Institute to Investment U this year, where he talked about his superabundance, and basically he shares your view that we are, make no mistake, that we as a world, we as a people are so much better off than we were 100, 200, 250 years ago. And there are some reasons for that, free markets and freedom and capitalism and you name it, all kind of conspired to allow innovation to take charge. And we're arranging the atoms better, and we're doing more with the resources than the cavemen did. The bottom line is we are far better off than we ever were.
Right.
And to stick we don't want to stick our heads in the ground and ignore the problems, because we all know there are problems, of course. Sure. But you also don't want to stick your head in the ground and ignore all the positives either, I guess is the point.
Right. Well, what I find, Rich, is that when I ask people about the positive things that are happening, a lot of people can't think of a single because if you watch cable news or you doom scroll through social media, it's just it's war, it's crime, it's corruption, it's natural disasters, it's murders, it's indictments of politicians. It's just one bad thing after another. I mean, you just can't wait to hit the off button, or most people can't. But so just to give an example of what are the positive things that are happening, because we all know the negative things. And anybody who's paying the least bit of attention to the news knows all the negative things. So let's talk just very briefly about the positive things. For starters, human beings have never had longer lifespans. In fact, the human lifespan has almost doubled over the last 100 years. And what could be more important than to have a longer lifespan? Infant mortality has plunged. Literacy rates have soared. It used to be 100 years ago that 90% of the world's population was illiterate. Now it's flipped. Now 10% of the world's population is illiterate. Standards of living have never been higher. We can thank capitalism for that, the greatest anti-poverty program and creator of wealth ever devised. Educational attainment's never been higher. Air and water quality have been improving for decades in the US. Even carbon emissions, people don't know this, carbon emissions are lower in the United States now than they were 50 years ago. That's why they call it global warming, not national warming. Not obviously places like China and India are spewing lots of carbon into the atmosphere, but there are lots of positive things happening. There's been a spike in crime recently, but long-term violence is declining. Divorce rates are declining. Abortion rates are declining. Domestic abuse is declining. Wars around the world are declining, which is one of the reasons why the invasion of Ukraine is such big news. It's the first battle with a major power since the Second World War. I mean, Russia, you just don't see major countries invading smaller countries. You can say that we did the same thing with Afghanistan and Iraq, but we weren't trying to take those countries over. There's been less terrorist attacks, there've been less civil wars, there've been less wars between nations. Technological advances, our communications are faster, our cars are safer, our transportation is quicker. So you've got all these advantages that we're living in a world that objectively our ancestors would look at as the realization of some utopia. And yet people are walking around with a little black cloud over their head because they watch the news and they hear every single negative thing. And yet polls consistently show that people think the world is in a horrible state and the country's on the wrong track or whatever. But then you ask them about their own lives and they go, oh, well, my own life, things are pretty good. My wife and I are living in a nice neighborhood. Our kids are going to a great school, blah, blah, blah. So people actually realize that in their own lives, things are getting better. And the reality is for the world at large, most things are getting better in most ways for most people in most places. And that's why I say, and this is not a matter of opinion. This is simply factual. Now we can argue about whether these trends are going to continue or not, but the people who disagree with that, they don't disagree out of a state of pessimism, but out of ignorance, because there are no charts showing human longevity declining and standards of living declining and literacy rates declining. They don't exist. So a lot of people don't realize these things are happening, but they are happening, and it does give you sort of a foundation for believing that maybe if the world isn't going to hell in a handbasket, I can take some of this money that I've worked so hard for and put it to work in the stock market because there are good things happening out there.
Well, I'd like to, obviously I agree with most of what you said because as you say, it's factual. And as a tangent, I think Marion Tupy has a daily letter that's free. Is it Human Progress?
Human Progress. It's a free letter. Worth seeing.
Yeah, I don't know if you want to add that to the email you send out, Rich, to all the attendees afterwards.
No problem.
I get it. I read it most days. It's pretty good. So there's no question of if we look at material, if we look at material things, that the world has got better over the decades and centuries and is continuing to get better. There might be some decades where we go backwards, but generally speaking, over the longer term, on a material basis, things have got better. I question whether, well, first of all, I do question, notwithstanding that literacy rates have improved, I do question whether educational standards in the West have actually got better over the last 50 years. And, sometimes as we get older, we tend to think that things were better when we were young. But I have to say that I think the education standards when I was a teenager were far superior to what, most teenagers in American schools or British schools, for that matter, are experiencing today. But generally, on a material basis, there's no question that things have got better. And not only do most people have a good life, but for most people, it's better than the standard of living of their parents and grandparents. But you mentioned a person from a couple of centuries ago. I mean, most people today have a higher material standard of living than the wealthiest king or emperor in the Middle Ages could even dream of.
Right.
Where I would disagree, or I would raise two other subjects. I keep emphasizing material. I think on some non-material measures, we are arguably not so well off today. And I'm actually doing some research at the moment for a talk I'm giving on medieval England, and no question the material standard of living was nowhere near what it is today. But in terms of independence, in terms of liberty, in terms of liberty from the government, in terms of privacy from the all-seeing eye of government, I would say the trend is downwards, not upwards. The other thing I would say, yeah, we can look at those graphs of 200 years of the stock market and how it goes up. But if you focus in a little bit, but you know as well as I do, but if you bought the stock market in 1929, even including dividends, you'd have to wait a long time to get back to break even. If you bought the stock market in 1966, and I'm talking about the stock market, not individual stocks or sectors, it didn't exceed 66 highs until 1982. That's a pretty long time. For many of us, that's most of our working life, most of our adult life. So there are these long periods when the market can, and not only can, but does, not do particularly well. And the problem, of course, is 66, 29, and I would argue 2023 share one thing in common, which is valuations were extraordinarily high. And if you start from a period when valuations are extraordinarily high, it inevitably means that you have lower returns over the next decade or two, and it inevitably means that your risk of losses over the next 5 or 10 years is increased.
Yeah, well, you've said a lot there, Adrian. Some of it I would agree with, and some I might take issue with. Let me begin by saying I didn't want to give anybody the impression that everything is getting better for everybody in every way, because we know that's not the case. And there are lots of serious problems out there that we have to deal with. We can talk about some of those. I will say that when people talk about the stock returns after 1929 or after 1966, I find that almost invariably they leave out the dividends, which reached 8, 9, 10%, double digits in the early 1930s. And Jeremy Siegel wrote the book Stocks for the Long Run, said if you bought stocks just before the stock market crashed in October of 1929, and you didn't panic and sell, a big if, because remember, people tend to act emotionally, and most people did sell or couldn't afford to hang on, especially if they were margined. You could buy stocks with 10% down in the 1920s, which of course you can't anymore. You have to put 50% up. But even putting 50% up means if a 50% decline wipes you out if you're fully margined. But if you're earning big dividends and you're reinvesting them, I think the Siegel said if you bought in 1929 before the crash and you reinvested your dividends, you at least were break even by 1934, which it was a very much longer time before the market achieved the heights it did at the peak in 29. But if you took all those big dividends and you keep reinvesting them while the market was down, then as it recovered, you came back pretty quickly. And so, like with the Gone Fishing portfolio, we've suggested in every downturn that you keep reinvesting those dividends, you keep rebalancing the portfolio, and it's worked out well. As far as this mentioned educational standards, Adrian, I could not agree with you more. The state of public school education is so bad, partly because it's a government monopoly. Public schools in this country are a monopoly. There should be I liked Milton Friedman's voucher program, or any kind of competition to compete, to have the best schools with the best curriculum, the best teachers, and the best graduation rates out there. One good thing that's happening is, and it's a well documented effect, is IQs, get this, not only in the United States but around the world, are actually rising. It's called the Flynn effect, named after the man who discovered it. IQs are actually rising. So while it seems like there's no end of people doing stupid things, generally speaking, people are more conscientious and more aware in a lot of ways, even if they don't have the factual knowledge. If you ask your average grammar school kid or even high school or college kid about medieval England, for instance, I'm sure they would draw a blank. So that oftentimes they have gaps in their knowledge, but their actual IQs are actually rising. And you can look into the Flynn effect. If you Google it, you can see that IQs are rising. So at least from that one standpoint, it's something to be positive about. But there are lots of negative things. I talk about the metastasizing federal debt. That's a negative thing. I always say that my liberal friends don't think the debt is a big deal. My conservative friends don't think 40 billion tons of carbon emissions are a big deal each year. They're actually both a big deal. And there are lots of other negative things happening. And here's what really needs to be said. As well as stocks have done in the past, and they've always come back, it's not like we're talking about the law of gravity, where if the stock market comes down, it's always going to come back. And this is why I suggest that people do diversify a portion of their portfolio into gold or into bonds or into inflation-adjusted treasuries or whatever, because no matter what has happened in the past, there is no guarantee of what will happen in the future. In fact, when someone buys a stock, you are guaranteed nothing. If you want a bond, at least you have a contract. You are owed principal. You are owed interest payments, and there could be a default, and you're going to have to recoup your money through a liquidation process. And the same thing happens with stocks. Although in the case of stocks, you generally don't get anything in a liquidation. But when you buy stocks, you are guaranteed nothing. That is why you diversify. That is why you asset allocate. And that is why you put some of your money in gold, because it's been a store of wealth and an inflation hedge, not just for decades, but for thousands of years. Longer than there have been stock markets, people have been holding and investing in gold as a way to safeguard their wealth.
Right, right. Well, you brought up gold. I was going to ask you about that. So let me mention or ask you about something else. Not getting off the gone fishing portfolio, but let's look at what Alex Green does with his own money. What is your talk about your strategy and your tactics? What is your time horizon when you buy something? Are you a top-down or bottom-up investor? How much importance do you attribute to macro circumstances, etc.? Tell us about your approach.
Well, I can say that the advice that I'm giving to my readers is exactly what I've been talking about here. These are strongly held convictions of mine, in case you haven't been able to tell. I mean, I really do. I guess partly is I do have.
I can vouch for that, Alex.
I do have sort of an optimistic bent because, like all people, I've had things that have gone wrong in my life. And when they do, I've had to suffer setbacks. I've always felt like if I applied myself, if I took responsibility for the situation, and incidentally, like I tell my kids, every time I've screwed up in my life, I go and have a committee meeting, like standing in front of the mirror and looking at the person responsible for the situation that I'm in. And I do tend to feel like things will eventually get better. That's just sort of my nature. But again, when it comes to the markets, you can look back and see that every recession that turns into an expansion, every bear market turns into a bull market eventually. So it is my own personal belief, and again, these are factual things, that are a lot of things happening in the background that most people don't notice that are positive for stocks. That is sort of the foundation of everything, is that in many ways the world is getting better. You don't hear about it, but for instance, the New York Times could have run the headline that 30,000 kids left poverty yesterday every day for the last 30 years, but that was never the headline because it was never news, because it was just something that happens gradually over time. So anyway, so what do I do with my own money? Well, I asset allocate my portfolio. I've got money in stocks. I've got money in bonds. As I've gotten older, I've shifted more of my money from stocks into bonds, just because I know I'm not going to go back to work and earn all this money over again. If the worst case happens, I mean, we're basically at war with a nuclear superpower in Ukraine, for instance. Yes, it's the Ukrainians who are doing the fighting, but let's look at what's happening. There's lots of things that could go wrong there. China can make a grab for Taiwan. That would be a very negative thing for the world. There are lots of, we could have another pandemic, a worse one. Imagine if rather than the coronavirus, we had the Ebola virus on the loose in the world. So it's not like that, no matter how good things were how much better things have gotten, something terrible couldn't happen in the future. So I asset allocate. Some of my money's in stocks, some of my money's in bonds, some of my money's in gold. I did collect gold bullion coins for a long time. I had Chinese pandas and, Canadian maple leaves and South African Krugerrands and Austrian Philharmonics and all these. I just liked looking at them, and I bought them on a
All
regular.
good choices, by the way.
I still get them out and look at them every once in a while. They're beautiful to behold, and with cash yielding 5.5%, actually more than inflation has been recently. I've actually put some more money in cash lately. And then when it comes to actually what I'm buying, I follow various strategies, one of which you're very familiar with, Rich. For instance, I talked about having an edge. If you're going to go in the stock market and you try to beat the index, you better have an edge. Well, here's a real edge. If you're an insider at a company and you have material, non-public information about the future prospects of that business. I mean, everything is happening with the customers, the suppliers, your employees, your customers, your competitors. And if you can take all that information, which again is not available to someone on the outside, and those things that are not available to the rest of us, and you're going to buy millions of dollars worth of your company's stock, well, you have a huge unfair advantage. And that's why the SEC requires an insider to file what's called a Form 4 with the SEC, detailing how many shares they bought and what date at what price. And that alerts the rest of us that someone with an awful lot of inside information is buying massive amounts of the stock. Now, lots of academic studies have shown that these insiders beat the market on a regular basis, not just anecdotal evidence. And so one of the things I do that I think gives investors a genuine edge is when I see an insider, or even better, a group of insiders investing millions of dollars of their own money in their own company stock at the current market price, we ride their coattails. And
something is up.
Yeah, well, it's not always the case. It's not like they're infallible. For instance, maybe you were a hotelier and in 2019 you thought like, wow, we're killing it. I'm going to buy a ton of my stock, and then the pandemic hits and everything you thought was going to happen doesn't happen. So there's no guarantee, but still, most of the time the insiders turn out to be right. And if you're riding their coattails and buying the same stock at the same time, or at least the same price, you tend to do very well.
Yeah.
So I do that with my own portfolio as well.
So if I come to you, Alex, let's say I come to you and say, hey, Alex, you really ought to look at this company, right? In addition to your, on top of your going fishing, but you really ought to look at this company. Apart from insider buying and selling, of course, what are the questions you ask? What are the things you look at? What's most important to you?
Okay. Well, so let's first of all talk about what the insiders know. The insiders know the direction of sales since the last quarterly report. They know of any new products and services in development. They know of if the company's gained or lost any major customers or made any big hires. Sometimes you have rainmakers you bring in from other firms that bring business from them. They know if the company is receiving any unsolicited takeover bids or whether anyone's thinking of taking the company private. They know the status of any pending litigation against the company. So they know all these things. Then I look at the insider and I go, okay, what is the size of the transaction? I want only big. I don't care about an insider buying $50,000 because he got elected to the board and now he's a member of the club. I want to see big 7, 8 figure transactions or even bigger. I want to look at the track record of the insider. You can go back through the electronically and see, did the insider buy the stock in the past? And if so, did he buy it low and sell it high? And if he did, when did he do it? And how often did he do it? And if he sits on the board of other companies, often an officer at one company sits on the board at another company, I can look at those trades. Did he buy those shares low and did he sell them high? And if he has a good track record for doing that, I'm going to rate his purchases higher than someone who doesn't. I'm looking at for what I call cluster buying, which means not just the CEO buying, but maybe someone who's a senior vice president who barely qualifies as insider. If somebody has a $150,000 salary and they buy $150,000 worth of stock, that's a pretty big signal, in addition to the head honcho buying millions of dollars with himself. So I'm looking at I'm analyzing what the insiders are doing, what they know, how they've traded in the past. And in addition, I'm doing my own valuation on what are the company's, what's its sales growth, what's its earnings growth, what's its profit margins. Are those profit margins protected? I always say that in the world of business, people who make money attract competition like bears to honey. Someone sees you doing something that's very profitable, they will come in and try to get in on your business and drive your profit margins down or take your market share. So you've got to have either patents or brand names or copyrights or trademarks, something to legally protect your profit margin. Warren Buffett calls this businesses that have a moat around the business. And that's got to, it absolutely has to be. You look at all the big bankruptcies of the last 20 or 30 years, Montgomery Ward's, Borders, Circuit City, Radio Shack, what do they all have in common? They had nothing to protect themselves from competition. And so if you're one of those companies, you're vulnerable. And so, and consequently, you don't generally see much insider buying there because nobody's more aware of these things than the people running the business. So they tend to be very sophisticated investors to begin with. And then in addition to that, they're not just talking. You know, anybody can flap their gums and say, oh, our stock is undervalued. When you're going to buy millions of dollars worth of your stock with your own money, you're showing that you've got the strength of your conviction. So big transactions show big conviction that the stock is undervalued.
Okay, and what do you put an overlay of what your view on the economy is or the sector?
No, Adrian, this is going to might surprise you because if you don't read my stuff, but I take an agnostic view. I don't know why this is more widely done, but I don't have a macroeconomic view that I lay on people. I don't say the economy is going to do this and expect interest rates to do this and the market's going to do this. I don't do any of that because it doesn't add any value. I don't know those things, and neither does anybody else. Now, all people say, well, nobody knows, but you have to guess. And I go, no, you don't have to guess. That's the whole. I'm trying to take the guesswork out of it. What can we know for sure that will take the guesswork out of it? Well, the things we know for sure are, for instance, that every time the market is sold off, it's recovered and gone on higher. We know that for sure. One of the other things we know for sure is you can look back through history and you will not find a single example of a company that increased its sales and earnings quarter after quarter after quarter, and the stock didn't tag along. Share prices follow earnings. So when you ask, are you a top-down or bottom-up guy? And for those listening, you wonder what the difference is. A top-down guy is somebody who lays out a macroeconomic view about the economy. Sometimes it's the whole world economy, which is very complicated. Nobody truly can understand it all. And they have this view on inflation, and they have this view on interest rates, and they have this view on who's going to win the elections next year, and this view on what the stock market is going to do. And they've got very strongly held convictions. They tell people to go out and buy this or buy that because of this top-down view. But the top-down view is often wrong. Like, think about this, Adrian. Coming into this year, what was the dominant view out there? The dominant view was, wow, inflation is running hot. The Federal Reserve is taking interest rates higher at the fastest clip they have in 40 years. And we're going to have a recession, and we're going to have a continued bear market, and blah, 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 blah. And that was the dominant view. And if you turned on CNBC, you heard it every single day. And what happened? No recession. The bear market ended this past spring. And so that dominant view was wrong. And so what I do with my readers is I say, look, we don't know. Nobody knows. I'm not ashamed to say I don't know what the economy is going to do, because nobody knows. But we do know that over time, stocks outperform everything else. And the best stocks are those that post the biggest surprises on the upside, come out with better sales, better earnings, and they are the ones that outperform the market over time. So we're going to focus on those companies. And how are we going to find them? Well, one way that we just talked about is we might concentrate on the companies where the insiders are buying millions of dollars worth of the stock themselves with their own money. So it's a bottom-up approach. We're analyzing businesses, not trying to figure out the world. And to the extent that I talk about the state of the world, I talk about what I think people don't hear enough, which is all the positive things that are happening, which get short shrift in the media. That people are living longer, standards of living, household income and net worth hitting new all-time highs, educational attainment never been greater, carbon emissions are declining in the United States, air and water quality is getting better, medicines are extending and saving our lives, new medical devices, new technologies, artificial intelligence is likely to increase productivity dramatically. That's been one of the drivers of the stock market this year, and so on. So to the extent that I'm talking about macro events, I'm really talking super macro, the long-term trends that are undeniable, that are positive Because why would you want to risk your money in the stock market if the world really is going to hell in a handbasket and the country really is on the wrong track and the economy really is rigged and et cetera, et cetera? Why would you invest money in stocks? I wouldn't. And yet people who think that, and this is one of the reasons why people are so quick to sell in a downturn. They go like, oh, I should never got in the stock market. The world's a terrible place and all these terrible things are happening. And now it's all showing up in the stock market. I'm going to sell. And then what happens? And then it starts going back up again, and having sold at the bottom, they want to know now they should get back in again. And that's how market timing works. And it generally doesn't work.
So I mean, if you know this, Alex, if you look at any graph in the paper on Bloomberg, let's say a 20-year graph of the stock market, you can hardly see 2008. You've got to really look, you've got to know it's there, and you've got to look for it. Oh, there it is.
Yeah.
So I want to go back to 2008.
Well, you sure felt it in 2008.
Yeah,
I'm sorry, Rich, go ahead.
No, I was saying I want to go back to 2008. So I mentioned earlier about the story I wanted to tell, and I think it was about this time frame. People were similarly very despondent. You know, the world's coming to an end, etc. We were at Investment U. I was standing at my booth, and I guess you had spoken. Somebody came out from the break and said, "Alex just said to sell my gold," and I'm like, what are you talking about? I know Alex has an allocation to gold. That's not an issue, et cetera. And we'll talk a little bit about gold versus mining stocks in a second. But, he said, Alex said to sell my gold. And basically, I talked to you afterward and I said, I know better. What's going on here. And there was more to the story, as you can guess. Basically, there was a lot of irrational exuberance around the gold market back then. Everybody thought the world was coming to an end. And there were a lot of people out there telling Alex that, hey, I'm going to 50% gold in my portfolio. And Alex said, that's crazy. You need to sell gold. And if they came to me, a gold dealer at that time, I would have said the same thing. That's what I told Alex back then. I said, listen, they can get the direction right, meaning that gold can continue to go higher. And it did for like 3 more years. And yet putting 50% of your assets into gold was absolutely dead wrong. So you can get it right and still be dead wrong because that's a crazy allocation, right? Yeah. So, the bottom line is Alex and I see eye to eye on this point. And I run into it a lot where, people say, listen, this is how much I have in my portfolio in gold. And I'm like, why? That's too much. Now, typically, when you talk to Americans, they'll say, when you say 5 or 10% in gold, they'll say, why so much? Most people will say that. Because they don't have that kind of cash available. It's tied up in their house or whatever else. And it's a lot of money for them to put into one asset class. You say that in Europe, you say that in Asia, and they say, why so little? Right? Because they've seen governments fail, they've seen banks fail, they've seen whole economies, in tatters, and they want to hold their wealth close to their vest. So, I know you mentioned precious metals, you have physical coins in your portportfolio. What about mining stocks? What about resource stocks?
Yeah, no.
Do they have a place?
I do like resource stocks. And let me first of all touch on the story you told, because I remember it well, Rich. And you were saying that someone came to you, they had most of their money in gold, and you said, and I remember this quote, they're wrong even if they're right. And that's an interesting thing. How could you be wrong if you're right? It's like if someone came to me and they're fully margined and they're making tons of money, and they could say, I'm right, I'm fully margined, but what they're doing is wrong, even if they're right, because they could so quickly lose everything or most of everything, taking that much risk. And you're saying the same thing. It's to have most of your money in gold, even if it turns out to be something right in the short term, is not a good long-term allocation. But I think everyone should own some gold. I own gold. I do like gold stocks. One of the reasons I like gold stocks is it's sort of a leverage play on the metal. Adrian knows this because he's a great gold analyst, and most gold companies have pretty high fixed costs. And so as the price of gold goes up, all of a sudden it flows immediately to the bottom line. They already had to cover all their mining costs anyway. So their margins improve, their cash flow improves, their revenue goes up, their sales go up, or their earnings go up. And of course, else goes up? The share price. And so you've got blue chip mining stocks, you've got junior mining companies, there's different levels of risk. You have to know what you're doing, because as Mark Twain famously said, a gold mining company is a hole in the ground surrounded by liars, and a funny quote, but it's true. You have to deal with somebody really knowledgeable, and an Adrian Day or a Rick Rule or somebody who really knows the business, because there's a lot of people out there who are really not. They don't have the assays to support what they're saying. It's all, hey, people drilling next door found this and people drilling over there, but that wasn't their property. Maybe their property's already been explored and there's not much there to go on. So I do believe that gold mining shares have a place in everybody's portfolio. And let me just say, one of the reasons why I think this is especially true now. I talked about the positive things that are happening. Let me tell you what I think is the most negative thing happening right now, and that is our constantly metastasizing federal debt. And I know everyone's going to go, stop. I've already heard this. I've heard it not just for years, I've heard it for decades, but it's something has changed. And that is the debt as a percentage of GDP is really, we're going to hit the debt held by the public, because what's held by the Fed just turns the interest payments back over to the Treasury, and then, the bonds mature and it's not going anywhere. But the debt held by the public is reaching 100% of GDP. And this is really a danger zone. And it's a danger zone because people always say, like, well, all we have to do is reform entitlements and stimulate the economy and blah, blah, blah. The politicians in Washington are not doing what they should be doing, especially they have no political incentive whatsoever to cut anybody's benefits in any way. Look at what happened in France when they just talked about raising the age of retirement a couple of years.
How'd that go over? Pretty
gradually. Well. I mean, they're mobbing the streets. And so, I really am concerned that it might come to the folks in Washington doing a Thelma and Louise. They just take us right over the cliff. They simply aren't willing to deal with the debt until it becomes the next financial crisis. And this could happen. I know there have been a lot of Chicken Littles that have told you this was going to happen for decades, but now we are in a different era. George Will famously calls this the most predictable crisis in the nation's history, that we have these out of control entitlements. And let me just give an example of how bad it is. Forget the deficit. Forget we have $1.5 trillion annual deficit during peacetime. Forget the $31 trillion in debt. The unfunded liabilities for our current, just for Social Security, Medicare, and Medicaid alone. And let me tell you how they determine these unfunded liabilities. They take the current population, the current revenues, projected revenues, and the current projected outflow for these, and the shortfall is called the unfunded liabilities. And the unfunded liabilities for Social Security, Medicare, and Medicaid are 2.5 times the GDP of the entire planet. That's how crazy this is. So it's not going to be, we're going to tweak this, we're going to raise the retirement age from 65 to 66 or 67. That's not going to do it. Or raise.
If a company was in this position, they would clearly restructure, reorganize, change the promises. Sorry, we can't do this.
Their debt would be the junkiest junk, for starters. Now, of course, the government can do something that no corporation can do. They can just simply crank up the printing press. The U.S. government is never going to default on its debt.
Sure.
But the thing is, because they can always just print more money. But what happens if the government just prints money to meet all these obligations? Then people are going to wish they owned more gold shares. And more real treasuries. Yeah. I mean, and it's it sounds like a nightmare scenario, but people call me the rational optimist, the guy who's always talking about the positive things, and I am. But on this one issue, I do think that we're sailing in uncharted waters, where the national debt is becoming more and more of a problem, because people talk about all the political fighting that goes on. They can't agree on what to have for lunch in Washington, D.C. Here's the thing that Republicans and Democrats are in full agreement on. They're not going to reform entitlements. Joe Biden at a State of the Union address said, we're not going to touch, the Republicans want to reform Social Security. There's this booze in Republicans. He goes, "Oh, okay, good. We're all in agreement. Nobody's going to touch Social Security," which he kind of did a rope-a-dope on him like that. But he's got Republicans and Democrats in full agreement that nobody's going to reform Medicare and Social Security, and it is a big issue.
I want to say it was like if I could real quick, it was like 6, 7 years ago, maybe a little longer. I was at the Vancouver event, Rick's Natural Resource Symposium as an attendee. Opening speaker was Bill Bonner. And he gets up there and he says, listen, I don't know why the hell you people are here to listen to me. He goes, for 40 years now, I've been telling you the world's coming to an end, the currency's going to collapse, the government's going to fail, and all this other stuff, and it hasn't happened. Why are you listening to me? That's how he started his talk. So, yes, that's been out there for a very, very long time, but I do agree with you. I think it's different this time. The pace at which that debt is escalating is unbelievable. And I don't think we've seen this before.
Right.
Yes.
Go ahead, Adrian.
No, sorry, after you.
Well, I was going to say, if you look at the projections, the Congressional Budget Office, they will tell you that by 2050, it's going to be a nightmare, and it could happen a lot sooner than that. The question is, I mean, right now, sometimes investors ask me, well, if the debt is so bad, why hasn't the stock market crashed? The stock market looks out 6 to 9 months. The U.S. is not going to have any problem meeting all its obligations for the next 6 to 9 months. We don't know. At some point, it's going to become untenable. People are going to realize that this is a serious problem and the politicians are not doing anything about it. And then we see havoc in the stock market. We see interest rates spike and bond prices come down, and negative effects in the stock market as well. And it's out there. No one can say, well, it's 3 years, 5 years, 10 years, but it's a risk. It's one of the reasons that I suggest that people own gold and own gold shares, because they are the traditional inflation hedge against economic and political disasters like this metastasizing debt.
Yeah, I mean, I agree with everything you said, with two caveats, and you said it very passionately, which is always good. But we both you and Rich, to some extent, sort of knocked the people who were talking about the debt 10 years ago. We could perhaps argue that they were more far-sighted than some people, because this is not a problem. I think it's a mistake to say everything was fine before, but now we're in a different world. This has been a gradually deteriorating situation, as you know. Yeah, I've forgotten the other thing I was going to say, but that's okay.
That's all right.
Do we have questions, Rich?
Yeah, I was going to say we've got a few. So I'm going to go here kind of in no particular order. One, Paul came in and said, I'm late, so I apologize if this has been already covered. If this is an ETF or mutual fund, is it available to retail investors through our brokerage account? So we were talking about the gone fishing portfolio.
Right.
I think at the time when Paul posted this question. So I don't know if you want to give some guidance as to where they can find that.
Okay. All right. Well, it is 10 different funds. You can buy the Vanguard mutual funds, or if you don't have access to Vanguard mutual funds, you can buy 10 ETFs. And I list the ETFs in my book, The Gone Fishing Portfolio. It's also on our website, the Oxford Club. But yes, you can do it with ETFs. You don't want to use actively managed funds because the expenses are higher and the performance is worse. But you can replicate the portfolio using ETFs as well as Vanguard mutual funds.
Anything you want to add to that, Adrian?
No, that's good. But I will add the thing I was going to say, which was, you kind of softened it at the end, Alex, but you did say that the US is never going to default on its debt. And I will take issue with that. I will guarantee you that if over the next 1,000 years, the US will default on its debt, number one, just as Rome defaulted on its debt and France defaulted on its debt, and pretty much every empire that's ever been out there.
Let me stop you there, Adrian.
Okay.
So, in 1,000 years, obviously, we could be, in the next 100 years, we could be nuked by China or Russia or whatever in a worst case scenario. But I'm just saying, in any foreseeable circumstance, why would the government not simply meet its obligations by making the currency worth less and less by deficit spending?
Be my other point. I mean, there's lots of ways to default. One way to default is just say, well, sorry, we're not paying you your interest. The other way to default is to depreciate the currency, which is what's done. As you know, since the Federal Reserve came in, the purchasing power of the dollar has gone down 99%. To me, that's a default.
Yeah.
Default by 1,000 cuts.
Yes.
Well,
But-
okay, the thing I don't understand though is first of all, if the US Treasury doesn't pay its debts, nobody, no corporation, no individual is going to pay their debts, because I mean, it would like be a total collapse of everything. So I would say that the Treasury will make, I mean, all of our Treasury obligations are backed by the full faith and credit of the US government. What's likely to happen is they will pay on all those bonds, but in a steadily decreasing currency,
Right.
with less and less,
Less
because
dollars. Yeah.
Right.
Yeah.
I think we're all on the same page there. And I think what Adrian's saying isn't that in essence some sort of a default? I mean, basically, if the currency that they're printing to pay these debts are worthless, then
right.
they
If
pay
we
their
turn
debt,
to Zimbabwe or the Weimar Republic, you're
Yeah.
right. It's like a default.
But
Okay.
so, yeah, I think we're all about the same place. So Chris asked a question, it's a fairly long one, bear with me. Say we have a recessionary period globally for a certain number of years or even a decade, with the following in mind: the shortages in supply of raw commodities and all the underinvestment in these important inputs in the past decades. Will the dampened demand, even in such a down period, still cause shortages enough potentially to see prices increasing in base metals, precious metals, wheat, crude, et cetera?
That's good for you, Adrian. It's right up your alley.
Well, I'll just make a couple of points on that. First of all, I'd separate the precious metals from the base metals and other commodities. I think a lot of people have the mistaken view. I mean, they focus on, if you're looking at copper, they focus on the electrification of the grid and EVs, and they look at the shortages of large new copper projects, et cetera, and all that is true. But I would argue that if the world goes into a recession, and it doesn't have to be a depression, just if we go into a recession, then the decrease in what I'll call normal demand will overwhelm these special extra demands, like from electrification, and prices will not go up. We should not expect prices of most commodities to go up significantly if the world is in a recession. Gold, because gold reacts to different things than economic activity.
Yeah, I agree. I think the monetary aspects of gold is much more important there.
Yeah.
I have two kind of tied together here. I don't know if these are questions or just comments, but the first one, I think they might be the same person. I'm not sure. Basis earlier in the conversation, it said some even believe we, and he puts in parentheses, or she puts in parentheses, Rockefeller family, so I assume they're a member of the Rockefeller family, are part of a secret cabal working against the best interests of the United States, characterizing my family and me as internationalists, and of conspiring with others around the world to build a more integrated global political and economic structure, one world, if you will. If that's the charge, I stand guilty, and I'm proud of it. So I don't know that there's a question there, but the next thing is the World Economic Forum: you will own nothing and you will be happy. What effect these revelations have on your investments? Anybody want to jump on that, or are we moving on?
I mean, that's a highly speculative thing. You will own nothing and you'll be happy. That sounds like some kind of Marxist utopia or something. I don't know, but
well, I think that's what came out of Davos. I think they're quoting some revelations that were shared there.
Yeah.
So
yeah, well, a lot of silly ideas come out of Davos, but I don't know enough about his hypothetical scenario to comment, really.
okay, all right, Adrian, same.
I don't have anything to add now.
Okay, all right. Another one. Think long term. Why does 1 year's performance even matter? Performance should be look at the very minimum of 3 to 5 year period chunks. Short-term orientation is the Achilles heel of any investor. What do you guys say to that?
I say he's right overall. Although you do want to look at your performance if you're badly underperforming the market. I think rather than saying 1 year doesn't matter, is maybe take a look at what you're doing. Maybe you're making some kind of mistake that you need to course correct in order to go ahead. But yes, you're going to have down quarters. You're going to have down years. The S&P 500 had a down decade from January 2000 to December 2009. And it didn't really matter for people who had a truly long-term perspective. So, long-term means different things to different people. For the U.S. government, long-term capital gains is 1 year, but most people think of, long-term as 5, 10 years and beyond. And you're absolutely right. What difference does it make what the market does in the next 6 months if you're investing to hit goals 10, 15, 20 years out? But then there are also people who are later in life, and that's the reason why they should have some safer investments. Obviously, Warren Buffett's 93 years old. He's happy to be almost 100% invested in equities, although he has got a huge chunk of cash in Berkshire Hathaway. But you're right. 1 year isn't an investment plan, and you do want to look at your performance relative to what you're trying to achieve to make sure you're on course. But a bad year means nothing in the great scheme of things. It's true.
No, I agree with that. I agree with that completely. And, I think one of the problems people have often is they will look at what happened last year, what did well last year, and they will jump on that. And then when it doesn't repeat in the next 12 months, they say, well, this guy doesn't know how to manage money, or this fund isn't any good, or whatever. And that's definitely a mistake, no question. And I always tell our new investors who come to us that obviously you should look at our performance, and obviously you should look at our performance in absolute terms, but also, particularly if you're looking at a gold investment, look at it on a relative basis as well. Because as Alex said, if you're a gold investor, you don't expect your gold manager to constantly underperform, the gold market and the XAU market. But I always tell our people you should always, give a manager and the same would apply to any investment strategy. You should give it 3 to 5 years to see if it makes sense. But I must tell a funny story, if I may. There's a very, very well-known investor. I won't name him, but I'll just say he's French. And he was asked about underperformance. A lot of value investors have these periods when they underperform growth, and that's always a problem for a value investor. A good value investor might do very, very well over 5, 10, 20 years, but they will have periods when they dramatically underperform when growth is doing very well. And this chap was asked about, he wasn't in .com and these stocks are doing so well. And he gave a Gallic shrug and said, sometimes you have a bad decade.
That's true.
So actually that leads in, I'm glad you told that story. It leads into, I'm going to ask the same question, I think, in a slightly, I'm going to come at it from a different angle, because I'm not an asset manager, I'm not a financial planner, et cetera. I know gold pretty damn well, but I look to people like you to do some other things for me that I can't do for myself, because I am busy running a company or paying attention to my family, learning how to play golf as well as Alex does, or something, along those lines. How often would you, as an investor, rebalance your portfolio? Because you can have issues within a short period of time, right? And sometimes that's just something, well, I have a long-term plan, I'm going to overlook it, I'm going out, the forever, like Warren Buffett, and I have value here. Or maybe something changes and you do have to revisit that and say, okay, maybe there's something going on here, and it's not just, maybe I just made a bad pick and it's time to do something. Or maybe it's still a forever stock, and maybe I've got an opportunity to buy really well here, and I should dump more money into it. How often do you look back at those things and try to make those determinations?
Well, let me point out one thing, Rich. When it comes to individual stocks, I don't think of individual stocks as rebalancing. I think of asset classes as rebalancing, and it makes absolute sense to add to your winners and to cut your losers. I always say that looking at your stock portfolio, you should look like you're viewing a rose garden. You want to tend to the roses, the stocks that are going up, and pull out anything that looks weedy. So the stocks that are going in the right direction are the ones you want to keep, and the ones that are not panning out are the ones you want to remove.
Of course, everybody does the opposite, right? They sell their winners and they throw money into the losers.
They hang on to their losers because they don't want to take a loss, and then they take a quick profit because you can't get hurt taking a profit, and they end up doing exactly the opposite of what they should be doing. But rebalancing you should do it really about once a year. You could, just like anything else, you can look in the rearview mirror and see when the perfect time to rebalance was. Obviously, January 1st of last year was a great time to sell some stocks and add to bonds or whatever. But you can, if you don't rebalance, what happens is, number one, your portfolio gets riskier and riskier as time goes by, because you're going to have more and more in stocks, because stocks outperform bonds over time. And you're also missing the performance kicker, which is, if you're in those years when stocks are down, if you add to them because your bonds are up and you rebalance, you're going to be buying low. So people who rebalance quarterly and monthly, they found that hurts performance and doesn't add to performance. Some people have found that you rebalance every 18 months instead of every 12 months, it works a little better, whatever. But you can't know these things in advance. And the question is not whether you should rebalance, but just when, and using an anniversary or your birthday or the first of the year, just something annual to rebalance is a good reminder that, it's time to make an adjustment to your portfolio. Some people talk about a buy it and forget it. I say buy it and don't forget it. You don't forget it, because you either rebalance your assets or you run trailing stops behind your individual stocks, and that's how you protect your principal and your profits with those trailing stops.
Yeah, I mean, there is as you said, there's a huge difference between asset classes where you rebalance and just individual stocks where it's not really rebalancing. And a lot of people, when it comes to individual stocks, they fall into two camps. There's the camp that says every time I've got a profit, I'm going to sell some. And there's the camp that says every time it goes down, I'm going to buy more. And I think both of those camps are wrong. And I don't necessarily say that if something's going up, we should buy more of it, because things do get overvalued. Let's face it, things do get overvalued. And buying more when it goes up kind of contradicts your rebalancing of the assets. You know what I found, and this is just an observation, I don't know how helpful it will be for anyone, but what I found is that when a stock price declines meaningfully, there are two different emotions one can have. If I'm worried and upset, it probably means I don't know the company well enough. If a stock price declines and I'm excited because I can buy more, to me, that's a sign that I really know that company very, very well. And it happened in 2008 when Nestle dropped by over 50%. I was ecstatic and I was loading up on it. Maybe I'm not allowed to say that because of the SEC or something, but I didn't say what happened to Nestle after I doubled up. Franco-Nevada declines. I'm excited, I can buy more. Ajax Consolidated declines. Gosh, I'm nervous. Well, that means I don't know it well enough, I think.
Right. Yeah.
Sorry, go on.
You're making a good point, Adrian, because when someone says my stock has dropped in half, should I sell it or buy more? That's a good question, but you can't know the answer until you know the company. Maybe it's dropped in half because it's headed for bankruptcy. Maybe it's dropped in half because of problems elsewhere in the sector or the whole market's down. So you have to know the reason behind the drop. And as you say, know the company well enough to be confident. I tell you, one of the things I do have a strong contrarian spirit with my own investments, and I've bought into every single market decline. The stock market crash of '87, I was like a kid in a candy store. During the pandemic, I was like a kid in a candy store, and I've bought into every single decline. And the reason is, when everything is down, it's scarier to me if I own a banking company and the financial stocks are up and this bank is down. That's scary. If the whole sector is down, I feel much more confident buying, because it's something, it's not specific to that bank. So you do need, before you decide whether to buy or sell, you need to know the company better. And if you don't have time to know the company better, you should be using a professional money manager like Adrian, because he is spending his time learning the companies, talking to the people of the company, and you can find a lot out. I've learned over the years that I can visit the company, I can talk to the employees, sometimes the managers, if they know that if you're just a customer. For instance, I've done this at a lot of retail stores. I'll go in there and I'll go like, wow, You guys are really busy. Is it just a store? Is it everywhere? Oh, no, I was at a regional meeting last month and everybody's having a record quarter. I mean, you'd be surprised at things they will tell you. If I came and said, oh, I'm a stock market analyst, I want to talk to you about XYZ company, they won't tell you anything. But if you're just a customer, like I got a couple of shares of this, I think I might buy a couple more. They're, oh yeah, they'll start telling you things that they're not supposed to say. But you can find information out by visiting the company and talking to people who are dealing with the company, suppliers, customers, competitors, and then you can make an informed decision whether you're going to buy more of the stock or maybe it's time to cut your loss or take your profit and move on.
Yeah.
Well, we're running deep into this, and I want to wrap up. There are only 2 questions. I'd like to cover them, and then I want to get a chance to touch everybody and have you give kind of final thoughts, final comments, et cetera, where people can reach you, where they can see you next, potentially what conferences you might be attending. So Alan asked, do you anticipate mortgage rates remaining elevated, even if the Fed cuts rates in response to some kind of crisis? And why would banks lend at lower rates if inflation remains elevated?
Is that for me?
For either one that wants to grab that. I don't have any thoughts. That's not my area of expertise.
Yeah, I don't know if anybody really knows what mortgage rates are going to be. Even mortgage brokers will offer an opinion, but they're often wrong. I will throw this out there. If you're thinking about buying a house and you're moaning about the fact that mortgage rates were 3%, now they're 7%, you can use what's called a contract for deed. What you need to do is find somebody who's urgently needs to sell their house, they're moving, or they have already bought another house, whatever. And you can do a contract for deed is you get seller financing. You make your payment to the seller makes their payment to the bank. You don't arrange new financing. You basically take over their old mortgage. And it's a great way to take advantage of old mortgage rates with new property. And I've done this myself many times. I did it 40 years ago about my first house. Not everybody's willing to do seller financing, but some people are. And when the mortgage rates that someone took out 3 years ago are half what they are now, it's worth looking into. So no one can really tell you what mortgage rates are going to be. I could hazard a guess, but it just is likely to be wrong as right. But I do know that you can find people who urgently need to sell and arrange seller financing, perfectly legal. A lawyer can draw it up. You're fully protected. You get all the appreciation of the property, and it is a great way to get low cost financing in a high interest rate environment.
Right.
The only thing I'll add to that is, though, one thing I do know is I'm pretty sure the banks are going to go ahead and lend at a much higher rate than they give out in interest on CDs. Let me see. William asks, what percentage of your portfolio, I'm not sure who this is directed toward, it could be any of us, is in gold? And what percent do you currently have in precious metals stocks? I bet we can all touch on this to some extent.
Okay.
Unless you can't because of SEC muzzle.
Well, I own gold and I own gold shares. I couldn't tell you what the percentage is. I can tell you that the Oxford Club's asset allocation models, we have 5% of your liquid net worth would be in gold and gold mining shares, or you include platinum and silver in there as well. What's your take on this, Rich?
For gold, and I don't really have a feel for the mining stocks. That comes out of, for me, that comes out of an equities allocation. I don't commingle that with gold. Gold for me is physical gold, right? So for me, personal opinion, everybody's different. This works for me. I do 10% of net worth in gold, physical gold, all times. That's my emergency fund. That's my wealth insurance. I never touch it unless I have a financial crisis. If that happens, I sell whatever I need to immediately. I meet the crisis, and as quick as I can, I replenish that allocation. In certain times, and I think now is one of them, with gold down around psychological, levels below 1900, silver back down to 22. I think they have the potential to go much higher. I think we've kind of got clouds gathering here where you can make some profit in precious metals too. And I handle that very differently. There, I look at maybe another 10, 15% of just investable assets, not net worth. In gold and silver, I weight that towards silver because I think it's got a better profit potential. And I rebalance that every year, right? So if all of a sudden my gold doubles or my silver doubles, I sell half of it. I don't hesitate. I take my profits all along the way. So I really don't care if I'm holding on at the top. And I look for certain things that are going to trigger that this is now not a dip where I might buy some more gold or some silver for the position, but this is maybe an end to the bull run. Things like duration of the bull market, the gold price, the GSR, the gold silver ratio, sentiment, a whole bunch of factors. I've given presentations on this. I did at IU here recently. And when those things start to come together, then I say, okay, this is not a dip that I want to buy. This is a time to start getting out of my for-profit position. And there are times when I have no for-profit position in precious metals, but I always have that wealth insurance. I never get rid of that. So.
Yeah, I agree with you on the difference between physical and mining stocks. And for me, with physical, to be honest with you, I couldn't tell you what percentage of my net worth is in physical, because having got my foundation, I simply buy coins, when I have spare cash and, when I sort of feel like it. And for me, it's the savings, I'm just saving them, as you say, not intending to sell them unless I absolutely have to. But it's just a savings, and I'm just building wealth, and it's going to be passed on to my daughter. With regard to mining stocks, I would not suggest or recommend that anybody follow my example. I have far too much in mining stocks. And I'll say two things about that. One is it's an area I know well. So a guy in Silicon Valley might have more of his net worth in more of his stocks in other tech stocks because he knows that sector and he can recognize good value. But I'm not recommending anybody do what I'm doing. But I will say I agree with you completely. Right now, I think you said this, but right now the mining stocks are at incredibly low valuations. On some metrics, the major mining companies are in their lowest 25 percentile of valuations for the last 40 years. And that's a signal to me when gold is at 1900, or today almost at 1900.
Yeah, it didn't finish there, that's for sure.
Oops, yes. Yeah. But when gold is at 1900 and the all-in sustaining cost is at 1200, the margins are still pretty darn good. And when gold is at almost 1900, we shouldn't be selling in the lowest quartile of valuations for the last 40 years. So, I think this is a good time to be overweight in the gold stocks. And the converse of that is also true. You were looking at some of the signs that tell you when it's time to sell instead of buy more. And I would say when the valuations generally, price to cash flow, price to free cash flow, price to book value, etc., are at historic highs, that is certainly a time to lighten up.
Good. So I want to make the rounds. I don't know who wants to go first. Alex, Adrian. Give us your kind of parting thoughts. Let us know where we can find you next. And just keep in mind that there will be, for everyone that registered and attended this webinar, if you registered but didn't attend, you don't have a chance to ask questions. So I thank you all for showing up and asking questions. But even those that registered and didn't attend, you're going to get a copy of the full video. We're going to send it out to everybody tomorrow. And with it, we're going to give you ways to access Adrian, Alex, etc. So there'll also be some specials in there, and I'll include the link for Marion Tupi's website as well. So whoever wants to go first, just give us kind of parting shots. Let us know where we can see you next. I know I'm going to be seeing you both relatively soon.
Right. Well, my parting thought would be that if you're listening to this, you should be investing according to proven principles. You don't just buy into somebody's worldview, their market view, their economic forecast, their political views, their whatever. There are so many smart, articulate people out there who are talking complete nonsense. No one really knows the answer to a lot of those questions. And you, as an investor, you have to accept the fact that to a great extent, uncertainty will forever be your inseparable companion. So the question is, if you don't know exactly what lies ahead, what should you do? You should asset allocate your portfolio. You should diversify your portfolio. You should cut your investment costs. You should make it as tax efficient as possible. And you should look for those areas where you do have an edge. Adrian is absolutely right. He knows the gold mining market as well as anybody I know. It's absolutely sensible for him to overweight that sector. I told a story in one of my columns a few weeks ago. I have a brother who's a very successful home builder. He told me he was getting out of the home building business, that there was this company, D.R. Horton, that they had such economies of scale and they bought so many lots and had options, so many lots at great prices, and that they could buy appliances at lower prices, and their financing was better than his. He goes, I just can't compete. Nobody can compete with it. I hung up the phone and I bought $100,000 of the stock in my IRA, just without even looking, just based on that conversation. And then I sold it when it doubled. And I said, I look back horrified. This was almost a decade ago. It's now up 900%. And this week it came out that Warren Buffett just took a huge stake in D.R. Horton. And but my brother knew the home building business. That information was crucial. And so if you want to overweight something you truly know and understand, the way Adrian does with gold, and I'm sure Rich does with physical gold. And aside from that, realize that you're going to have good months, good years, bad years. But if you stick to proven principles, you'll be just fine in the long run. As far as where I'm going to be, Rich and I are going to be at Lake Tahoe, but unfortunately it's a private wealth symposium, so I don't like seeing most of the people watching at that event. But you can visit libertythroughwealth.com. I write a free e-letter. I put my views out there on what's happening in the market and why and what you should do with your money. It's free, libertythroughwealth.com, and you'll always be able to find me there.
Highly encourage you to do so as well. And look for notices about Investment U next spring as well in that newsletter. So, all right, Adrian?
Yeah, I agree. I agree with your parting thought, and I'll add another parting thought, which you've sort of hinted at, which is basically know yourself. Know what you're good at, know what more importantly, know what you're not good at, know what you don't know. That's the most important thing. People can find me at adriandayassetmanagement.com. You know this, Rich, I say this every webinar we do. If anyone has any questions that they didn't ask, please send them in, and we'll, certainly I'll do my best to answer any questions that I can. And well, my next seminar is in Vancouver, September 9th, I think, the Saturday, whatever the Saturday is, when I'm at Giant Bandari's seminar, and I'll be talking on liberty in medieval England, which I'm sure everyone is terribly excited about. But past that, I think the next one will be New Orleans, I think.
Are you going to be in New Orleans, Alex, as well?
I don't have any plans to, but who knows? I might end up there.
I know I've seen you from time to time there, and I'll be there as well. So that's the 1st through 5th.
First to 4th, 1st to 5th. Yeah.
I love jazz and I love food, so I'm tempted to be there already.
Yeah, I can taste the andouille sausage and the char-grilled oysters on the flight down. So my parting shot is, you were talking earlier about how when something goes down and you are not scared because you believe in it so much. I'm kind of that way with gold right now. And I don't want to say back up the truck and get 50% of your assets in gold. But if you don't have your allocation, my God, I think now's a great time to consider getting your allocation filled in gold. And we'll have a special in the email tomorrow helping you do that if you have a care to. I look at the long-term gold chart, like you look at the long-term stock charts, Alex, right? And I know as long as we value gold, or we measure gold's value with mismanaged fiat, that chart goes up. I mean, I don't know how any other way for it to happen. For real assets will go up in value as long as we measure it with mismanaged fiat. So if you're ever doubting these short-term dips where gold drops from $2,000 an ounce down to just below 1,900, you're wondering, oh my God, is this the end? Zoom out take a look at the long-term chart, and there's no question in your mind what you should do. You should buy well and take advantage of the dip. You should embrace it and not be afraid of it. And that's where I am at gold right now. So that's my parting shot. Again, there'll be a special to help you if you share that view to buy more gold tomorrow in the piece that we send out. Where you find me next, I'll see Alex in Lake Tahoe. I'll see Adrian at New Orleans Investment Conference, Brian London's affair. And, I hope to see you all out at those places as well. Just leave the parting thought that it's not so bad. I was really looking forward to this webinar. We have it better. When people talk about how bad it is in America and they're going to leave the country, I'm like, you're crazy. I've been all around the world. I've never been anywhere where they have as much as we take for granted. All right. So get out from under the gloom and doom, do positive things, and I think your portfolio will respond. I think Alex and Adrian are good examples of that. So, and I thank you all for joining us this evening. Thank you both, gentlemen. It was
And thank you, Alex. That was great.
So,
Yeah, enjoyed it. Thanks so much. Happy to do it
Thank
again.
you. Thank you. Bye.
All right.
Thank you.
Bye-bye.